Mobius joins us now. Always a pleasure to interact with him, understand from him that what his view of the world is, and really get insights on where is he traveling and how is he traveling. All right, Mark, which part of the world are you joining us from?
I'm now in Singapore. I just got back from Vietnam, Thailand, and Malaysia. So I've had a real tour of Southeast Asia.
So, how's the world looking like, Mark? Suddenly we are talking about challenges in America, big problems in Europe, and a repeat of 2008. In your understanding,
Well,
2023 and 2008, what is the
yeah,
similarity? And
my
what
feeling is that there's a great deal of confusion right now, of course, because what you have is a situation where people are thinking maybe my money in the bank is not safe. Uh, and then you have on the other side the government in the US and now in other countries trying to prop up the banks. And that is a big question mark whether this is going to be successful. So far, it's been successful in the US. And of course, in Switzerland, it happened. But people are really beginning to question the safety of banks. So that's the reason why you've seen gold go up and you've seen Bitcoin go up, because people feel that maybe these two areas would be safe from any problems that the banks have or any problems that you see in the governments. So that's a very, very significant change that's happened with a great deal of uncertainty. Of course, in this market, the emerging markets have underperformed the US market because people, of course, are looking at China. And China, of course, is the biggest component of the market, the emerging markets index. But if you look at what's happened in Taiwan and Korea, you'll see that those two markets are doing quite well. India has come down a little bit, but the good news for India is that exports from Taiwan to India are going up, which is a very significant change, because that means that more and more semiconductor business is going to be flowing into India. And I think, as I mentioned before, this is going to be very positive for India.
Suddenly, a lot of asset classes have become disjointed. Crude is down, copper is up, gold is up, and Bitcoin is giving gold some company. Why is that this time around, in this financial risk-off moment, we have seen a very disjointed move in all financial assets?
Yes, that's right. It's very disjointed, but it does make a lot of sense, because if you're afraid of your deposit in the bank, where do you go? Do you go into stocks? Not really, because people feel that maybe the stock market will not do well if the inflation numbers go up and the Fed becomes more aggressive on interest rate increases. So if you look around, okay, what's the place to go? It's gold and maybe Bitcoin, because they feel Bitcoin may not be affected by these other factors.
Mark, Indian markets are down 20% from the high in dollar terms. Chinese markets are down 45% from the in dollar terms. Obviously, that makes China much more attractive. And that narrative, I guess, has been at play in last couple of months. Do you think this narrative of book profits out of India and move to China is real?
No, I think what's happened is that you've seen some recovery in China, because China now has opened up more. The COVID situation has pretty much been suppressed. And now the Chinese government is saying, look, we welcome foreign investment, and therefore they're, trying to encourage more investment in China. But it really has not worked very well, because you can see the Chinese market has come down. And the reason for that, of course, is that the biggest market makers in China are the local people who invest in the stock market. If they're not confident, or if they don't have the money to put into the market, then the market will not do very well. And of course, that affects the emerging markets index, because China is about 30% of the index.
Mark, have you increased your allocation in this decline in India?
No, we've kept it the same. We're looking to increase as we go forward, but right now we've kept it the same as we've had. So we still have a very positive outlook for India.
I'm assuming that India is your top weighted market in terms of absolute percentage commitment.
Well, if you look at our weighting, you'll see that it's much higher than the index because we feel more confident, and we have most of the assets now in terms of China and Taiwan is Taiwan. You look at the biggest allocation is Taiwan and then India. So at the end of the day, we have great confidence in what's happening in Taiwan. And as part of that, what's going to happen in India as India becomes more semiconductor oriented, as more and more manufacturing takes place in India.
Mark, I recently came across an interview of yours on global media where you've gone on record and you've said that, look, as in Chinese, as an investor, I'm worried about my money, which is in China, where I'm not allowed to withdraw the money. Is it true? Are you facing that problem?
That was the problem, but now it's been solved. Thanks for the news. People at the banks began to wake up and realize that it doesn't make sense to be holding up my money in China. So I've been able to solve that. Thank God.
Mark, you had 3 stocks in India last time when we interacted with you. Have you made it 4? Are you planning to make it 5 or even 6?
Well, I'd like to make it more and more. And the thing that I'm looking at, of course, is the whole technology area, and not necessarily the software, but the hardware. I believe that this is going to be very interesting going forward. So I'm really interested in increasing that allocation in India through those channels.
Why do you like technology in India? Because Indian technology sector is still exposed to the global macros. The global macros are looking challenging. Indian IT companies get a lion's share of business from the BFSI space, and that's where the global problem is. Are you not worried about it?
No, the reason why I'm not worried is that when you get down to it, when companies are in trouble, or when societies are in trouble, when governments are in trouble, they turn to technology to solve their problems. And technology often can solve their problems. So the technology area is going to grow globally in any case. But more importantly, India is going to be taking a bigger and bigger role in the semiconductor and hardware area, in the semiconductor technology area. And the reason for that is that the problems with China and the US means that a lot of the manufacturing that has been taking place in China has to move away. That's the reason why Taiwan manufacturers are looking to India as a place to manufacture and to keep up their services to their clients in America and Europe.
Mark, so for those who keep on pointing out this consistent fact again and again, which is that Indian markets are great, Indian economy is moving in the right direction, but Indian stocks are not fairly priced, but they're richly priced. So if you're buying gold at the price of gold, you are unlikely to make great gains.
Well, if you look at the Indian market from a longer term perspective, the potential is incredible. I'm not too concerned about these short term moves. The market could go down 10, 15%, even 20%. That really doesn't concern me. In fact, it could be an opportunity to buy more. So it really depends on what stocks you're holding. If you're holding stocks with very little debt, with good return on capital, then you should do fine, regardless of what happens to the market.
Mark, so if you have to, let's say, construct the market in a time space, next 1 year, where do you think markets are headed? Next 3 years, where do you think markets are headed? And next 5 years, where do you think markets are headed? And what do you like within India? How would you decode it for us?
Well, as you know, I'm a perpetual optimist. I believe that markets will continue to go up. There will be big corrections. The good news is that when there's a big correction or when there's a bear market, it's very short-lived. It tends to last no more than a year. And then that provides an incredible buying opportunity. So it doesn't make sense to try to predict what's going to happen this year, next year, 3 years, 5 years from now. The best thing to do is to find the right stocks, stick to those regardless of what happens, buy more when the price goes down, and you'll do very, very well. So I have to say, this year, next year, 5 years, the Indian market will continue to do well. There'll be corrections along the way, of course, but at the end of the day, those who are in the Indian market in good stocks, in stocks with low debt, they should do fine.
Mark, we saw a comeback in value last year. We saw a comeback in commodities. We saw a comeback in the non-ESG dominated stocks. A tobacco company like ITC and a mining company like Coal India, they made a comeback. What led to this kind of an outperformance? And do you think this comeback in value stocks is here to stay?
Well, it's not a matter of necessarily value versus growth. It's really a matter of the ability of companies to determine pricing. In other words, those who are able to fix prices to higher than inflation. So we have to look at price makers rather than price takers in India or anywhere in the world. These are the companies that you want to look at. So at the end of the day, it's not a matter of what the market is doing in general, but what these companies are doing specifically. And I believe there are many companies in India that are price makers. In other words, they're able to fix prices ahead of inflation and continue to do that going forward. Not many of them, but there are enough to provide a great opportunity.
Mark, do you think ESG investing and the compulsions which were there around ESG investing, is that passé now? And is it time to move on? Because 2 years ago, 3 years ago, global equity markets were giving disproportionate premium to ESG companies.
Yeah, I think the ESG, the sustainability business became sort of popular. Everybody jumped on the bandwagon. Many of them are just doing it for show. But at the end of the day, we believe in ESG plus C, C meaning the culture of the company. And the reason why we believe in ESG plus C is that it reduces risk. If you have problems with the environment, with your company, if you have problems with the society around you, if you have problems with the corporate governance, and if you have problems with your own staff, that's a big risk that we don't want to have. So that's the reason for all the companies in which we invest, we look at the ESG plus C components. Of course, each company is different. You can't apply sort of a blanket measure. But at the end of the day, these are very, very important risk control measures.
Do you think for next 3 years, everyone should have a must-have exposure to gold?
I think it's very good to have some gold in physical form in case of real big emergencies. I don't see gold as a great investment because it doesn't produce earnings. It's static, so that it's not really the kind of thing you would want to include more than 5 or 10% of your portfolio. But it is important to have it in the case of a real breakdown. I mean, you must remember, we've come very close recently to a complete breakdown of markets in every direction. And of course, when there's war and other strife, it's always good to have some gold, particularly in physical form, hopefully in coins, so that you can carry it and use it as money.
Mark, so I go back to my opening question once again, because that currently is the moot point. You are absolutely clear in your understanding that the US financial system and the European financial system is stable, and this is not going to be a repeat like 2008.
It's not stable. I wouldn't say it's stable, but I would say the central banks around the world realize the tremendous risk they face, and they have to move very, very quickly to support the major banking systems and the major banks. That's the reason why the Fed moved so quickly to do something about the technology bank that we saw failing in Silicon Valley. There's no question that we are in a very unstable situation because we have many of these banks holding long-term bonds, which have lost their value as a result of the increase in interest rates. So in some ways, the central banks are in a bind because on the one hand, they want to raise interest rates to lower inflation. On the other hand, if they raise interest rates, the assets of these banks holding fixed income instruments are going to be in trouble. And that's, of course, what happened, and the reason why this bank in Silicon Valley and others got into trouble. So we're now in a very, very, shall I say, iffy situation, a very dangerous situation. And we have to be very, very careful as to what companies we hold, and particularly ultra careful about banks, which is the reason why we don't hold any banks in our portfolio.
Mark, couple of follow-up questions, last couple of follow-up questions actually. Over the years when you've invested in equities, how much importance have you paid to macros and the Fed commentary and the interest rates?
Well, what we do is we look at two major macro factors before going into a country. Number one, will we be able to get our money out? And therefore, we look at things like foreign exchange reserves, regulations on foreign exchange, et cetera, et cetera. That's number one. Number two macro issue is, will the government take over our company? This, of course, as you know, happened in Venezuela when companies, that Chavez came in and he said he was going to nationalize many of the companies. Therefore, we got out. So I would say these are the two big macro issues we have to deal with. Then we look at individual stocks, and every stock is going to be different. If you're looking at, let's say, a stock in the hospital or healthcare area, you have to look to see if the government is going to impose any restrictions on how much these banks, these health companies, these companies can charge. If they're going to be restricted by the government, then there could be a problem. And the same thing with banks. If the banks are going to be restricted by the government in how they can charge and how can they run their business, then it's a big problem. So that's the way we look at the macro issues in relationship to the market generally. First of all, it's the two big macro issues, and then it gets down to the individual company.
Just to wrap it up with one final question, Mark, to your mind, what exactly are financial markets pricing in? Are they pricing in a peak in the interest rate cycle very soon, or they've already started pricing in some slow recession stroke or slowdown in the second half of this year? What do you think markets are pricing in?
What they're pricing in is, number one, a possible bank failure, possible breakdown in the banking system. Although central banks have come to the rescue so far, there's still a lot of doubt in the market as to whether the governments, and particularly the central banks, are going to be successful. That's number one. Number two, the market is pricing in is a possibility of higher and higher interest rates. There's no question that we're now standing at inflation in America at 5, 6, 7%, regardless of what measure you're using, and that's far away from the target of 2%, which means that the central bank, the Fed, must raise interest rates. So these are the two things that the market is pricing in, and it doesn't look very good from many perspectives in that sense.
Mark Mobius, always a pleasure to have you on ET Now. Thank you so very much for accommodating this interview request.
Thank you.